Hello traders, welcome to this questions and answer session. There's two questions that I'm going to tackle here on the same Q&A video because they're a little related and they're also not related, but one is rather simpler to answer than the other. So I'll just take the time to do them both here. Now this one's by Fisher, and he asks, hi bro, by all means you are a much better trader than me. But I would like to still ask you this question. When backtesting, did you really requalify the order flow like you did today? Meaning a couple of days ago. This post is a couple of days old. I only practiced harmonic trading for 3 weeks or so, but I did notice that sticking to the main swing is much better. So in this case, that would mean no trading today because no proper retracement for an entry. I understand that this is frustrating when the market is bitchy. But you are such a good trader and your videos have so much value and so fun to watch that I can assure you, you don't have to worry about anything. Your public image is fine. Anybody in a tiny bit of brain can test and see for themselves. Okay, no, thank you for the nice compliments. I'm enjoying the mustard seed account. I'm enjoying the challenge of the small account. I'm enjoying the drawdown and the repetition, the making me more making me stick to my rule set with more conviction. Because of that, I'm enjoying you guys watching the whole process, watching how you can get stuck in the mud and just keep applying your trade plan, keep applying the money management, and you can see how many just how much longevity you get out of a struggling situation. As long as you stick to your game plan, you stick to your process, you stick to all the things that keep your account with the focus of growing it in mind, and you don't get into this mindset that, oh, I'm in drawdown so I need to recover. No, you don't need to recover. You need to keep making the same decisions you've always made. The only thing that may or may not change is the money management aspect of it. You may need to scale down when you're in drawdown, when your money management system says to. Okay, and I would never ever stay at 2 contracts if my money management system has me going to 1. Okay, I can get a little more aggressive if I'm on a winning streak, and when it says to trade 1 and I'm above my beginning capital, that I can trade 2 contracts. I'm not over leveraging at that point, but I do have to understand that if I do take a hit, you may have to drop down immediately to 1 contract, and that's fine. Okay, but never ever do it at the expense when you're in drawdown that you're going to trade heavier to recover quicker. That is surely a recipe for disaster. Now the main question was that when I did my back testing, did I really requalify the order flow like I did today, or like I've been doing recently when the swings are long? The answer to that question is no. Okay, and the reason why that is because we didn't have these huge swings that we're having now pretty consistently on a daily basis. Back when I was when I put my trade plan together and when I was trading and just my overall day-to-day operation, we were not seeing this on a daily basis. We will see it sporadically. We will see it every now and then. The Forex market, when I first started out, it was I used to trade the Forex market, and you do have very volatile days with huge swings, but we don't get them every day here. We're getting them pretty consistently, which kind of puts us in a situation where you are right. If you stick to the main swing and you wait for a proper correction, you're going to be better off. The issue with that is that sometimes that swing is so large and your stop has to be so far away that it doesn't make sense to do that from a risk standpoint. Taking on that kind of risk, when an expectation can fail at any time, puts you in a situation where one hit can really weigh negatively on your account. And although these swings have been quite large here, and I've taken on, even with this vulnerable small account, 70, 60, 70 point risks, and I have taken some losses on those wider stops, which have contributed to vulnerability of the account. um, you know, I have elected to try to requalify the order flow. Now that gives you some benefits and also gives you some challenges. So the benefits are that you can requalify into a smaller order flow that's emerging, because all order flow leads you to the same place. Okay, so it gives you an opportunity to participate at a better price, meaning smaller risk, and you're also taking smaller rewards. Okay, but it's an order flow that's manageable. Okay, those are the benefits, that you can get yourself an opportunity to participate when the order flow expands to the point where you would normally not be able to participate. That draws some problems. The problems is that, you know, that order flow has also had some frequency already, because in the process of qualifying that order flow, you know, a couple of swings or 3 swings, so by the time you realize you can requalify the swing, maybe a few swings have passed by. And what does that mean? It means that you've already passed up on some of that frequency to get to that expectancy. Okay, so that's another problem. Okay, and yeah, sure enough, once our market gets to that corrective point and then it ends up following the overall expectation, you may end up taking the one or you know, the trade that's going to fail. But by staying on that order flow, you're going to eventually realign yourself and then capture the nice swings that are going to help you get back on track. Okay, so is it something that I recommend everyone do? No, that's not for everyone. You know, you have to understand that you are entering into you're going from one order flow into another one, and you are sacrificing some of that frequency that's going to get you to that expectancy. Okay, and the biggest problem with that is that if you don't stay on that order flow and you don't take as much of that frequency as possible, you're actually doing yourself more disservice, because, you know, we don't know which ones of these are going to fail and which ones are not going to succeed. I'm sorry, which ones are going to succeed and which ones are going to fail. Okay, and eventually that smaller order flow is going to fail quicker, you know, especially when it's against what the market is working towards. Okay, so the quicker you get involved with that immediate order flow, the more benefit you have, you know, to capture as much of that frequency as possible to get to the expectancy. So no, I have not done the back testing to requalify that, and I don't think I really need to. Understanding that those are fundamental facts, this is not something that you could go back and test with a whole lot of accuracy, because these swings and you know, come in, you know, pretty randomly. They get huge, and then the order flow eventually develops. But what you need to have is some clearly identified rules that are going to lead you to the process of qualifying an order flow as quickly as possible. You know, so you need to have a set rule. What is a main swing, you know, value that's too large for you to trade? 80 points, 90 points, 100 points. So once you have a new structure high off of a higher low, or new structure low off of a lower high that's more than 100 points, so now you can't trade that anymore because the stop is unaffordable to you, and or it may not fit your emotional state. So you need to qualify the immediate order flow or an emerging immediate order flow, because that swing is large. You know, the price does not move in a straight line, and that corrective process of the big swing may be a small, short 5 or 6 swing in micro order flow leading you into that correction to then continue on. And that's tradable. That's tradable, but you need to identify it quickly, and you need to have a clearly defined process for doing that, you know, if you're going to do that. Okay, the best answer for you guys, and it may fit your comfort zone, is to just not trade. Nothing says you have to trade today. Okay, but you know, if you feel comfortable doing it and you can qualify that order flow, by all means do that. And I thank you again, Fisher, for the nice comments. Yeah, I really don't care too much about what people say or think. What I do care is when people say something that may steer or influence the newer people, and it's a comment that's based on nothing more than either, you know, that has no substance behind it. We'll just leave it at that. But thank you for your comment. I hope I addressed your question. And as far as harmonic trading, you've practiced it for 3 weeks. I encourage you to you know, to start, you know, using harmonics more in your trading, as you know, the market does seek this symmetry. And that's going to lead me into the other question that I have here from our good friend Oyasumi. I'm sorry if I butchered your name. Okay. He wrote here, hi Mr. Pip, thank you for starting your thread and providing your expertise. I have learned a lot so far, and it is a new way of looking at price action for me, besides relying on candlestick patterns, indicators, and even volume to make decisions. I was wondering in general, why do you think ratios and harmonic work? What is it about the market that it follows these principles a lot of the time? You know, and I know you mentioned down here that you started reading Scott Carney's book on harmonics, and that he mentions that he even doesn't really know why these patterns work, but they do. I can tell you that I don't know a 100% objective answer to your question. I can tell you what my hypothesis is. You know, I believe that the market has a natural order to it, and we know that because the market seems to move in this staircase format, right? And it does so consistently. And the staircase price action is this new structure high, higher low, new structure high, higher low, new structure high. That's the essence of price movement. So as such, it has that general flow, okay? And when the low is eventually broken, it tends to continue, okay? And sometimes you get failures or back-to-back failures, but for the most part, that's the essence of price movement, okay? We don't know why that is, and we can, dive into that and say, well, in order for profits to be realized, the opposite transaction must be transacted, and because of that, that causes a turning point when enough people do that in a specific area, right? And that's what causes the ebb and flow of the market. It's a process of give and take, right? And at some point, some people that were, in a particular direction, go to a deeper loss than they wanted to, and they force close that transaction through a stop or what have you, and that causes other people that are maybe getting long and short there. So it's a process in give and take, but understand that the percentages are the same on either side, right? Because for every win there has to be a loss. So the only thing that changes is which side are you on. But winning to loss percentage, it's the same. For every winner there has to be a loser, and for every loser there has to be a winner. Okay, so from that standpoint, we're balanced. Okay, now who outplayed the other person, or who had more pain tolerance when they're on the wrong side of it, is determines who win. Because sometimes the market comes down and doesn't hit your stop, you were on the pain train, but the other people probably didn't have the tolerance you did and closed their positions earlier, which caused the vacuum in that area to cause price to eventually move in your favor. Okay, so we don't want to take more pain than necessary, but we do want to make sure that we put our stops in the right area, and sometimes that may have you taking more pain than you would like to have, but it is necessary in order to ensure or to have the possibility of achieving that expectation. Okay, I can also tell you that the market does strive for symmetry. Why is that? I'm not sure. Is it a self-fulfilling prophecy? Is it something that our eyes are geared towards patterns, or geared towards things that repeat themselves, or to some extent something that visually we can see, or we consistently look for a specific type, like maybe the market as a whole, right? We don't know. I'm just speculating here, but maybe as a whole, people like 40 points, 40 points of profit, from an intraday standpoint. So an intraday price range may have consistent 40 or 50 point swings, with the occasional one that falls short when there's breakdown, or that extends beyond when there's strength in buying. So for the most part, I think that most retail traders or most intraday traders have a certain profit target that's pretty consistent across the spectrum, and probably that's why there's so much symmetry in the market. maybe the symmetry is a visual representation of something that makes people feel comfortable, saying that there's exhaustion there. 100% move of the previous move, it's something that's balanced, something that makes sense. Remember, the market as a whole seeks equilibrium, right? So I think in swings it's about the same thing. I think that once a market develops its range for a swing, that tends to stay the same, whether they use ATR or whatever it is. But I think the market as a whole, in a swing context, I think that once the market decides what that swing is, people feel comfortable, taking that range and trading it. And eventually, depending on what areas you interact with, there may be more buying or more selling in that area that may lead to either price breaking down or price strengthening, taking you past an exhaustion area, and the market can stay overbought or oversold, like in this case, or sometimes this happens, intentionally or not. Sometimes they wanted to do this up here, but they didn't have enough orders. They had to create the imbalance, so they had to consume and accumulate over a larger area to be able to create the imbalance. And once you run out of money, things like this happen. Okay, so I can't give you a clear mathematical or an honest answer as to why the market seeks symmetry, why harmonics work, or why ratios work. I can tell you probably why ratios work slightly better than I can the harmonics. And I think ratios, I think that there's a large portion of the trading community that uses Fibonacci retracements more than extensions to look for areas of support and resistance within the swings, right? Because that's what Fibonacci ratios do. Think of this large swing here as this is a level of resistance, this is another level of resistance. This is where price, mathematically should find resistance. And if you think about it logically, the rule of thirds applies to life. It applies to this as well, right? This is 1/3, this is 2/3, and this is 3/3. That's why the 38 is powerful. The 50% is the pivot, right? The balance beam of the swing. So if you're technically staying below the 50, what does that mean? That you're slightly more bearish than you are bullish, right? And if you cross over that pivot sign, that's an indication of breaking down, and that you are looking that the buyers are getting stronger because they got past that balance beam of that swing. But nonetheless, taking it into simple context, Fibonacci retracements are nothing more than potential areas of resistance in this standpoint, or possible areas of support coming down this way. Okay. And the extensions are areas of support, right? Resistance and then support, okay? And these are things that a lot of people use, and when you use them, and because there's a large portion of the community that use them, well, it adds strength and value to them because more people are making decisions that are likely going to be similar to yours at these ratio levels, okay? So, but that's why I don't like ratios alone. Remember, I tell you, my SOS1 signal, okay? If I have only a ratio and I don't have structure, that's the weaker of the SOS1 signal. I'd rather have an SOS1 signal that's a price pulling back to immediate structure in the absence of a ratio. And when I have a ratio and structure combined, that's an SOS2 signal that adds a stronger signal because everybody can see structure. More people, in fact, almost everyone that trades should be aware or concerned about structure, and only a percentage of the population that trades uses ratios, so they have value, but structure is king. Price action is king because everyone, in theory, can see the price action, right? Not everyone uses ratios, not everyone uses moving averages, not everyone uses harmonics, okay? But these things have some degree of value. Now, I particularly don't like moving averages because what have I learned? It doesn't matter whether you put a 7-period moving average here, a 21-period moving average here, a simple moving average, an exponential moving average, a 200 moving average. Price is going to have, an appearance that is going to be reacting to those levels. Okay, and you can throw them all on there and you will see, oh yeah, look, the 200, look, price reacted to it. Oh, look, the 7, yeah, look, it reacted to it here. Oh, the 21, whatever it is, okay? But that doesn't mean that that is a self-fulfilling prophecy or not, okay? But I don't like the moving averages, because no matter which one you put on there, you're going to find price reacting to it. And it, of course, is going to. Why? Because they're a derivative or a mathematical calculation based on price that's already happened. And because of that, there's going to be a moving average interaction with price in some way, shape, or form. Okay? The bigger ones are going to have more value because they're going to get touched less. But when they get touched less, they're going to have more value because, why? A 200 moving average, if you think about it, it should give you exhaustion areas with more clarity, right? Because price has to achieve more to get to that 200 moving average than it does a 7-period moving average, right? So look at the moving average as a, as an order flow. The 200 moving average is going to give you the longer term order flow. The 7-period moving average is going to give you the more immediate order flow. And maybe the 21-period moving average may give you an intraday order flow. I don't know and I don't care. But the point is that, anything that is measure or derivative of price is going to interact with because of that phenomenon. I mean, because of that mathematical calculation. It doesn't mean that it's going to add any value to that indicator or process, okay? If you don't understand what the framework of the market, what the price action behind, what is driving, what is the engine driving the market is going, then it doesn't matter what tool you use, okay? That's why I particularly like harmonics, and that's why I particularly like ratios. Why? Because they're not a derivative of price. It's something that, price is either going to achieve and it is not. And I know that since the market strives for symmetry, that is something that I can continue to use and project forward to add value to my decision making. Okay, well, let me continue reading the question and then I'll show you guys a quick little thing here about the ABCD. But that's my spiel on whether it's the candlestick patterns, the indicators, or volume. All these things are going to have an interaction with price. The more sensitive you put them, the more the immediate order flow, or the more the immediate occurrence or situation that you're looking to capture. The more extended you put them, like the longer the period, the more periods you capture, you're looking to identify a price interaction with a longer term order flow, right? So, it doesn't matter what you put on there, you're going to find price interacting with it to some extent, okay? So that has little to no value unless you can have a clear process that every time price touches that, then you're going to act in a certain way, and understanding that that's going to lead to failures, but your money management system that complements that should help you survive, overcome, and maybe even make profit. I'm not the one that's going to say here that any indicator-based system is not going to work. No, I'm just saying that indicator-based systems that are oscillators or moving averages directly on the chart, all those are going to be lagging. But no matter what setting you use, they're going to appear like they have value because they're going to interact with price at some point. Of course they are. They're a derivative of what you're looking at. There's a mathematical calculation that averages what you're looking at. So there's going to be interaction. Okay? So how much interaction you have with it is going to vary. And you need to understand whether the settings that you have on indicator captures an immediate event, a intermediate event, or a longer term event. Okay? And how you address price getting there and what your trigger is going to have a direct impact on whether you do well with that or not. Okay? Because just because price touches the 200 moving average doesn't mean you need to sell. It means that there is exhaustion there, or there should be longer term exhaustion there, but nothing says it needs to turn. You need more information. So that's where people that use indicators fall short, is that they use the indicators as the trigger as opposed to using the indicator to indicate to them a specific condition that may or may not exist. It's a heads up. Hey, market, it's at the 200 moving average, or the RSI, or the MACD, or the stochastic, or the tricks, or the freaking CCI, whatever the hell is overbought. That doesn't mean that the market can't continue to climb for another 200, 300, or 1,000 points. It just means that if you're planning to sell, be careful. The market, I'm sorry, if you're looking for buying orders, be careful. The market may be overbought. That doesn't mean don't buy and sell. Okay, that's where people get it wrong. But again, why do ratios and harmonics work? I think that they're a stronger way to trade because they're not a derivative of price, but a tool that you can use to measure. And the market has a natural order. The market seeks for symmetry because these are things that people can see, and we, in short, are looking for patterns that repeat themselves. So I think we've created, this subconscious order to the market because we have this need to understand where to buy and where to sell. And it's just one of those things that turns into a self-fulfilling situation. That's my personal opinion. It's not based on any facts other than how I believe these things form and why are they continue to be profitable throughout the test of time and throughout the time spans or tick spans or whatever chart you use. You're going to find these things playing out, and the only thing that changes is the order flow is relevant to that tick chart. Like, for example, an 89 tick chart, most people say, oh, it's full of noise, you can't trade that. That's not true. That's the immediate order flow you're highlighting. You're going to have more frequency, and with more frequency comes a lot more trades, and with a lot more trades come more winners and more losers. Okay, that's something that you need to understand. Okay, you need to plan for that. Okay, now, for example, an AB equals CD pattern. This is price making a strong move, retracing and making another strong move. So is it strange to expect that all of a sudden price will reverse after this pattern? The answer is yes and no. Okay, that's why when I look at ABCDs or AB equals CDs, you have to look at them from the standpoint of order flow analysis. Okay, and order flow analysis tells us, let's get back to the chart here. Let me delete all these things. Okay, so let's talk about an ABCD pattern, and let's look at this one right here. Okay, so we have pretty good momentum here, right? And then we have a correction. Okay, the correction was deep, right? So the correction was to this area here. Price found support right where price had found support before. So I got long there, even though I should have, not been in that long. Let's not get back into that. It's in the post-session review. That's out already. But your goal is to project this forward. Okay, so you have a correction that's slightly deeper than half, right? So you don't really have deep price action here. So you have a mid to slightly deep correction. You expect a mid to fairly shallow projection. At the very least, your projection should be a 1-to-1. So when you see a projection like this, what is this? This is a good projection, right? So you would expect, okay, let's take it back a notch. Okay, so you have a correction, prices start moving up. You got long here. You expect this to be your high or low. Okay, so now when you project this forward, what kind of a projection are you expecting? Well, the harmonic projection tells you that you should be expecting a decent projection or a good projection. Okay, the deeper this goes, so this goes down here. If this goes down here, that's going to weaken the projection. Okay, but the projection is still supposed to be pretty. Oh, sorry, I messed up. Okay, so the deeper we fall into this, okay, that's no longer, remember, a traditional ABCD pattern, it's a pattern that goes between the 618 and the 78.6. The pattern goes deeper than that. Okay, it's no longer an ABCD pattern, it's an AB equals CD pattern. In this particular case, we had significantly deep correction into an area of structure. We didn't break the expectation. The price had a deep correction. So an AB equals CD pattern doesn't necessarily mean that the market is strong. It could be that there is breakdown in the market and you're expecting a very weak new structural high that in this case does not reach the 127 extension. Okay, now you can consider, okay, anything that goes past the 127 extension to be strong, right? Because this is level 1 exhaustion, level 2 exhaustion, this is level 3 exhaustion, should be the strongest of exhaustions. You're going to get that when price goes, oh my gosh, sorry guys. If price goes, and this is all relative, right? If we go to the 38%, you're going to achieve the 1618, right? If you go slightly deeper, okay, here, you're going to achieve somewhere in between. You get to the 618, you're going to get to the 138, okay? You get to the 786, and you're going to get close to the 127, okay? So that's how you gauge what kind of a projection should you get, okay? That should be indicative of how deep you correct, right? And then you can tell yourself, well, if you have weakness on the correction, meaning that, yeah, you got here, but it was like this, like it took you forever to get there, you can say that, okay, I may expect this kind of a projection, okay? I'm still expecting a one-to-one, but since I got weak momentum coming down, I should get pretty good momentum coming up, right? And you're going to see that when you see, you know, a certain move here, a certain pitch, right? This is the low, this is the high, right? No cheating. Look at how the correction was raggedy. Okay, that should increase. That should help you on the projection. See, the projection stays the same or better. Okay, and when you have steeper momentum on the correction, even though you didn't get very far, there's a little more force there. Guess what that's going to do to the momentum on the climb? Look, it weakened it, right? Now the momentum's pitch went like this. We still achieved it, but it was more raggedy. So as we pay attention to order flow analysis, we can have an expectation as to, you know, should we get a good projection or not? That's going to be dependent on the one-to-one. That's what you should expect. The market strives for symmetry. So when you if you don't know visually, then project it. Don't be afraid to project it forward, because that's going to give you an idea of what kind of a projection should you get. Well, this is where I entered. Now, if price continues to move forward, you're going to have to do this, right? Or if it doesn't get there, you're going to have to do this. And you say, well, I was expecting a raggedy correction, or I was expecting a shallow correction, so I should expect a great projection. Okay, a great projection means somewhere in the 1618 here off of the off of the 38. Now, if you were expecting a good correction to the downside, and you got a really raggedy one, okay, then you should expect, you know, easier price movement to the upside, right? Why? Because the sellers were weak in the correction. That's when they should be the strongest. They struggled to correct. What does that mean? There's buying strength in the market. The buyers did that. The buyers weakened them down. So what does that mean? Less money to defend on the way up, increasing the momentum and possibly increasing the projection, okay? That's sometimes when we see the market gaining strength, right? Okay, so what may lead, like here, right? Well, we have a situation here where, you know, we have this move here, right? And we have, you know, the market is very balanced, guys, and you know, and it's beautiful to see this. Now, we didn't make a close above the high of this candle, so you know, you could argue that this area here did not achieve a new structure high, depending on what your rules are, okay? But this is the way I would see this, even though price did make a clear high here, but we did not close above the high of this candle here, so we did not make a new structure high, okay? Now, moving that forward, we can see how price kind of, you know, achieved that on a couple of swings, okay? But notice how the correction was very raggedy, right? We didn't get any deeper, but the sellers struggled, okay? Although it looks like we got a weak new structure high here and another 100% correction, that would be indicative of breakdown. Well, you know, shouldn't have price off of a weak correction, projection made a deep correction. Did we really get that? No, we got slightly, you know, mid to slightly deep, and then price came up, made an even weaker projection. Shouldn't the sellers have been able to, at the very least, get past this area here? They weren't, right? And then the market eventually comes up. But because of this raggedy correction down here that really didn't get very deep, the buyers were able to do what? Achieve better projection. Okay, one thing leads into another. Same thing here. We had increase in projection. We have an ABC to the downside here, 100% correction. Okay, although it's kind of raggedy, but these two swings had some momentum behind it. What do you think that's going to do to the next projection? It's going to weaken it. Did we still achieve a one-to-one? Okay, the answer is yes, we did. Okay, but you have to understand the dynamics of harmonics and what makes a harmonic move and what kind of a projection should you expect, and also can be looked at as to what kind of a correction we should get. You know, weak projection equals deeper correction. Okay, how the sellers have been defending, okay, from a momentum standpoint, you can measure that too, right? Look at the momentum here. Look at the momentum there, pretty similar. Okay, then the momentum what? Shifts, right? There's a stronger, more momentum to the downside, not better projection, still holds to the structure, but that's going to lead what? To a harder move to the upside. An opportunity for the sellers to what? Defend their territory. We see that here. They didn't get very far. The expectation was for a new structure high. But this right here was a direct result. I'm sorry. This right here and this weak projection is a direct result of what we see happening here. Okay, so studying the order flow, having an expectation from the order flow, understanding harmonics, how harmonics plays into this, gives you very good insight as to not only the symmetry, but a very good understanding of where exhaustion points are going to be, where areas of interest are likely to be, and then when you add the structure and the ratios to that, it just becomes a very, very, very powerful combination of confluence that's going to help you be right more often than not. Okay, now I too, okay, that's why I love this video, that's why I love these questions, because it drives me back in, you know, that sometimes we don't lose our way, you know, but sometimes we don't really put the emphasis on these things that are like the golden bar and not the golden nugget. This is the golden bar. Okay, the market strives for symmetry. Okay, master these concepts, you know, do them in your day-to-day trading. I need to do them more. You know, I've taken for granted that I know this, and I visualize this without putting the line on the chart. And then sometimes because you don't have the line there, your eyes start reading other stuff, and you lose a little bit of that situational awareness that I often tell you guys that is so important to maintain. You know, in front of you, okay, and not in the background. Okay, so this little video here has a lot of value because I just showed you how balanced the market is. I also showed you how you can use harmonics to help you understand, you know, where price is likely to go and come to. And also I've shown you how you can use order flow analysis to help you understand whether your trade is going to move efficiently or struggle a little bit, okay? And based on that momentum, that projection, and that depth, and how you achieve that momentum, projection, and depth, leads to the next expectation becoming what? A little raggedier, deeper, or because you were expecting nice projection and you didn't get nice projection, you should expect a deeper correction. And whenever you expect a deeper correction, you cannot rule out what? A complex correction of a more immediate order flow, because price does not move in a straight line. And within these little swings here, within these areas here, you know, territory was argued and fought over here, here, here. You know, these are all footprints of, you know, sellers that tried to absorb here, and then the buyers came in. Well, guess what? That's going to have an impact in the future. Then the sellers came in here and here and here to absorb. Guess what? They did so here too. You know, there is nothing random on the chart. Everything is there in front of you. It's a little hard to decode sometimes, but when you walk in there with the right framework, the right expectation, and understanding of harmonics and order flow, okay, and have an expectation on the expectation, then more often than not only are you going to be in the right price, on the right side of price, but you're also going to be able to capitalize from that. Okay, so that's about it. That's all I wanted to say. It's not so much that an AB equals CD is a market that is strengthening, but more so it depends on where that correction terminates, and what kind of a one-to-one do you expect to the upside that tells you whether the market is strengthening or not. And just because that line is there, it doesn't mean that the market is strengthening. If price gets there and price turns from there, the market is what? Harmonically balanced, because you're getting one-to-ones. It's when you have a deep correction and you expect the one-to-one to come here and it goes there, then now you can say, I have an extended C to D leg. The market is in fact strengthening to the upside, and now I was expecting a mid to deep correction. I need to amend that because of the strength to the upside means that the sellers are probably going to have a tougher time correcting because of that extended projection. Price may not come to that immediate structure, but price should always be expected to correct to the 38%. That's how we qualify our main swing. Okay, like price is expected to at the very least hit the one-to-one or that 127. Okay, from a ratio standpoint, I always expect price to hit. If price makes a new high, I expect price at one point or another to interact with that 127. Okay, now because the market is harmonically balanced and we know the market seeks symmetry, we start trailing there aggressively, because if we do get taken out at that point and the market does correct there back into this area, now we're expecting a deeper correction because of the weaker projection. Okay, and we are able to participate again, and we don't give money back and then look for another entry. No, we capitalize on that one-to-one, let the market correct, and now we have a different area of confluence that involves around the 127 of the swing you measured and the following one that didn't go very far. Draw two. I don't draw an inversion. Let's say this swing, for crying out loud. Sorry. I kept pressing F9. All that does is stop the recording. I'm sorry. Let's say that price corrected to here and to there, and now the 127 is there. So now you have an area of confluence of the 127, the 138. You have a lot of ratios that come into play here, and you have a exhaustion area here. So this becomes your what? Your PRZ for that D entry short. Okay, because you have all this situation, you're expecting a nice correction. Now, should you expect off of a strong move a deep correction? No. Okay, remember that the market seeks symmetry. Okay, so to make a long story short, okay, you are expecting an average, or a mid to deep correction off of a symmetric move, because there's a little more exhaustion there as a whole. That doesn't mean that you're going to get a deep correction. Okay, just like when you get an extended A to B leg, okay, you shouldn't expect that pattern to play out to this 618 of the pattern. Like here also, what is a good indication that you're going to get that deeper correction? And this is the example of that. You have a clear leg here, and the second leg is what? Weaker in momentum, a lot more raggedy, sellers involved all the way up. That's going to lead you into a very good probability of price reaching that 618, or maybe even going beyond it. Okay, but when you have a raggedy first leg and the second one is stronger, that D leg, that price is showing you momentum's increasing. You need to be careful, because that D completion may extend. Make sure you give it room. Make sure you get a good rotation, even if it's a little deeper. Okay, so that's pretty much all I have on this Q&A. I hope it has value to you, and thank you so much for your time.